What's up, traders? So today I'm going to show you a strategy that I've labeled the dividend wheel, where I do the wheel strategy on high dividend stocks and ETFs that pay out monthly. And by doing this, I'm able to generate huge profits. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market, and I use the money I make from the stock market in order to pay for my entire lifestyle. Now, before we get started, you know that you have to go ahead and smash the like button. You guys have been showing out for the last few videos. I've been asking for 500 likes, and both videos got over 1,000 likes. So we have to keep the ball rolling. We need at least 1,000 likes. So go ahead and smash the like button, or you could just gently press it. However you want to connect with the like button, please do so accordingly. All right, but you can also subscribe to the channel. Have a ton of great videos coming up here soon. And do remember that I am not a financial advisor, and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. Now, before we dive deep in how to use this strategy, I'm going to show you the 3 stocks that I like to use it on the most. And so without further ado, the first stock is Realty Income, ticker symbol O. Now, for those not familiar with Realty Income, they are a REIT, and I believe that they are the 7th largest REIT in the world. And they currently own over 11,000 commercial properties. All right, so they are a pretty big deal in the REIT industry. And I'll tell you one thing, commercial real estate is the place to be, because I personally previously owned a few restaurants. And when the pandemic happened in 2020 and it shut down a ton of businesses, well, guess who was still getting paid? My landlord. He did not care that there was a once in a lifetime pandemic going on and that our income went to zero. He was like, well, your money's still due on the first. And when I talked to several of my other friends who also own restaurants, they all had the same scenario. Their landlord wanted to get paid whether we could operate or we could not. So needless to say, commercial real estate is a good place to be. But we can see here that it's currently trading for $55.85, and it's a $50 billion company. And if we look at the chart over here, we can see that it pretty much trades in a tight range. And that's usually the case for a lot of high dividend stocks. So we can see over the last year, it's traded between $50 and $65. And it hasn't gone outside of that range. And then over the last 6 months, it's pretty much traded between $50 and $60. All right, so not a lot of volatility when we're talking about stocks with very high dividends. Now, speaking of the dividend, if we look right down here, we can see that the dividend is 5.65%. So that is really high, and that is exactly what you want when you're utilizing the strategy that I'm going to tell you about here shortly. But that's the first stock. Now let's move to the second. So the second stock is actually an ETF, and it is ticker symbol SPYI. And NEOS is the S&P 500 High Income ETF. But we can see that this ETF also pays out monthly. Now, this one does have an expense ratio. However, it is nothing compared to its dividend. Look at this, 12.11%. All right, and so that is huge, especially considering an ETF that follows the S&P 500. Now, your next question should be, well, how can they pay this high of a dividend? Well, let's take a look. We can see right here, it says this fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. So this ETF sells covered calls, and the money that they collect from selling covered calls is how it's able to pay such a high dividend. Now, in return, oftentimes the capital appreciation for an ETF like this will be capped. So essentially you're swapping out, getting higher returns to the upside with a guaranteed monthly income. All right, but now let's look at the second benefit of this ETF. It's actively managed by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. What that means is the income that you receive from this ETF gets taxed as a 60% long-term capital gains tax rate and only a 40% short-term capital gains tax rate. So that is a huge benefit when it comes to tax savings. And now let's take a look at the fund's performance versus the S&P 500. Now, if we look at this column right here, we can see the year-to-date performance, and we can see that this ETF's performance is down 3.25% for the year. However, it is beating the market as the market is down 4.92% for the year. Now, this data is as of April 30th. All right, so as we know, the market has gone up quite a bit more. However, we can see for the first 4 months of the year that this ETF did beat the S&P 500. However, if we look at the past 1 year, we can see that the ETF is up 10.69%, while the S&P is up 12.10%. So you give up some of that upside for those guaranteed monthly payments. And that is the second stock. But now let's look at the third stock. And the third stock is ticker symbol QQQI, which was also created by the NEOS fund. But instead of following the S&P 500, this ETF likes to follow the NASDAQ 100. But same exact thing, monthly payments for the dividend, expense ratio is 0.68% as well. And this dividend is 13.92%. So out of the three, this dividend is actually the highest. And just like with SPYI, this ETF also sells covered calls in order to get such a high dividend. And you also have a tax advantage with this one as well. But let's take a look at how this ETF performed compared to the NASDAQ 100. All right, so same exact thing here. This is data as of April 30th, but we can see that this ETF was down 4.64% as of that date, but the NASDAQ was down 6.65% as of that date. So this ETF is outperforming year to date. But now if we look at the 1 year performance, this ETF did 12.92%, while the NASDAQ 100 did 13.10%. So a slight beat by the NASDAQ 100, but that's basically the same return. But now that we have our three stocks, let me show you how to generate even more income off of these stocks using the wheel strategy in a specific way that greatly increases your probability of profit. And also, if you know anybody who could use help generating income off the cash that they already have, then tell them about the Trade to Freedom community. Not only will they get to see my exact trades when I enter them, but they'll also get my full options course from A to Z. Thirdly, they'll have access to ask me questions at any given time. And lastly, they'll be within a community of other traders who all have the exact same goals as them. So if you know anybody who could use help generating income off the cash they already have, then tell them about Trade to Freedom. The link is in the description below. But now let's get back to the wheel strategy. Now, first things first, what is the wheel strategy? Now, if you're new to options, I'm going to explain everything now. However, if you're already familiar with the option strategies, make sure you stay to the end because I'm going to show you a better and more effective way to go about it. All right, so with the wheel strategy, the first thing you want to do is sell a put. And when you sell a put, you are agreeing to buy a stock at a cheaper price. And for selling a put, you receive money. And then once you buy the shares, you can turn around and sell a covered call. And with a covered call, you are just agreeing to sell a stock at a specific price. And when you sell covered calls, you collect money as well. And then once you've sold the shares, you have completed the wheel strategy. But that's why it's called the wheel strategy, because you can just continue to do those steps over and over and over again. But let me break down selling puts and selling covered calls a little bit more. So when you sell a put, there are two main objectives. And it's one, to generate income, or two, to buy the underlying stock at a cheaper price. So when you sell puts, you either one, want to make money, of course, and or two, you want to buy the stock at a cheaper price. And selling puts is literally like selling insurance for stocks. And here's what I mean. Let's say I have ABC stock that is currently trading at $100 and I like the company and I want to purchase the shares. So I could potentially sell a put at, let's say, $90. And as I'm selling a put, I'm essentially saying to the buyer, hey, I will buy your shares of ABC stock that are currently trading at $100 and I will buy them from you if the stock crashes below $90. However, for doing so, you have to pay me, let's say, $200 right here, right now. And this contract is only good for the next 30 days. And from there, two things can happen. Let's say ABC stock stays above $90, then we just keep the $200 we were paid and we go about our day, and we can do that trade over and over and over and over again. However, scenario number two is if ABC stock drops below $90, then we still need to purchase the shares of ABC stock at the $90 that we agreed upon. However, we still keep that $200 that we received. And so as a put seller, you are essentially selling insurance for the stock. And just like with your car insurance that you pay every single month, the insurance company keeps the premium that you pay them whether you get into a car accident or you don't. And so here's a quick example of selling a put with a real stock. So let's say Apple stock is currently trading for about $220. And let's say you're interested in buying Apple stock at a cheaper price. Then what we could do is we could sell a put, let's say at $200, and that would be our strike price. And we could select an expiration that is 30 days out. And for selling this put, we would receive $150 immediately right here, right now. And so if we look at this profit and loss chart over here, so Apple stock is currently $220. If the stock price were to go up, then we just keep the $150 we received. If the stock price stays the same, then we just keep the $150 that we received. If the stock price goes down some, we still keep the $150 we received. However, if the stock price dropped below our $200 strike, then we will be forced to buy 100 shares of the company per contract that we have. And that's literally how selling puts works. However, now let's go and take a look at the few data points that I look at prior to selling puts. And so the objective with covered calls is to generate income and profit from a stock that you already own. And that is the reason it's called a covered call, is because you already own the shares of the company. So when you go to sell a call, it is covered by the shares that you own. And here's a quick example using Apple again. So let's say we own 100 shares of Apple at the $165 mark. That's the price that we paid for the shares. So that is our cost basis. Well, now we could turn around and sell a covered call, let's say for this example, at $185. And we'll still do it for 30 days out, and we received $200 for doing so. Well, if we look over here at the profit and loss chart, this is how this works. If Apple stock goes down, you keep that $200 that you received. If Apple stock stays at around $165, you keep that $200 you received. If Apple stock goes up some, all the way up to $185, you just keep that $200 you received. However, if Apple goes above $185, then you still keep the $200 that you received. However, now you are forced to sell your shares at that $185 mark that you agreed upon. But here's the great thing about covered calls is not only do you get to keep that $200 option premium that you received, but you also get the capital appreciation of the stock. So we bought the shares of Apple at $165. And if it goes above 185, then you still get to collect that $20 price appreciation on top of the premium that you received. However, now you cap your capital appreciation at whatever strike that you selected because you agreed to sell the shares at that price. And so let's go ahead and take a look at a covered call. Now, the first stock we'll place a trade on is Realty Income, ticker symbol O. Now, there's a few data points that I like to look at prior to placing any trades, especially for individual stocks such as O. And the first thing is the Bollinger Bands. Now, the Bollinger Bands are these black lines here, but they just aim to show you the price range that a stock is expected to trade within. And normally it's about 95% accurate. As you can see, typically trades within it, and then maybe some days it'll pop out, but it goes right back in, pop out, go back in, pop out, goes back in. All right, but 95% of the time, it typically trades within the Bollinger Bands. Now, if we look over here, we can see that the stock price is currently right in the middle of the Bollinger Bands. And what I like to pay attention to are the lower Bollinger Bands. So we can see this lower line here is at $54.89. And so the stock price is currently expected to stay above that. So that is a number that I want to pay attention to, and that is $54.90. So now I'm in Thinkorswim, and the next thing we need to do is select our expiration date. Now, typically, I always go within 45 days out. So we can see that the only expiration date that will fit that criteria is June 20th, which is 23 days out from now. So now that I have that selected, what I want to do is come over to the put side and sell a put that is near the money. And so in that case, that would be this $55 strike, which is pretty close to our $54.90 mark that the Bollinger Band told us. And we can see if we sell a put here at $55, that we'll currently receive anywhere between 60 cents and 65 cents per share, which is $60 to $65 per contract. Now you can see that there is a red marker here, and that is because I'm already in this trade. And if you are part of the Trade to Freedom community, you received this signal over 2 weeks ago. And so we collected much more than what is shown here. But we'll go ahead and go with this $55 strike. And now typically I would only do deltas up to 0.20. All right, so if we look over at this delta column here, we can see that this is a delta of 0.36. So there's about a 36% chance that O drops down to $55 by this expiration date. And I typically go with deltas of 0.20 or lower. However, with REITs and high dividend ETFs and stocks, they don't move as much. And so in order to get a good bang for your buck, you have to go to a closer to the money strike. And since I'm genuinely fine with owning the shares, that is a-okay with me. Because here's how things will work out. One, we will receive premium from selling the puts. And let's say O stock goes down and we are assigned the shares, which means we have to buy the shares. Well, now that we own the shares, we'll get paid that monthly dividend. And on top of that, once we own the shares, we can go ahead and sell covered calls. But we'll get to that in just a second. So let's go ahead and look at this trade of selling the put at $55. So we'll just go ahead and click this bid price, and your brokerage will automatically load the ticket for you. So you can see we are selling, and then right here we select the amount of contracts we want. Now you can select as many as you like by whatever fits your account size. But for the purposes of this video, let's say we're going to do 5 contracts. And we select our premium at the mid price, which is currently 0.62. And if we want to go ahead and place a trade, then we'll select the review button down here. However, let's go take a look at the P&L chart. All right, so if we take a look at that number there at the top left, we can see that we collected a total of $310 for this trade. All right, $62 times 5 contracts gets us $310. And we can see at expiration, if the stock price just stays exactly where it's at, where these green dots are, then we just keep that $310 we received and we go about our day. And then also if the stock price goes up, then we just keep that $310 we received and we go about our day. And if the stock price goes down some, we just keep that $310 we received and we go about our day. And it's not until the stock price goes below $55 that the contracts become worth less and less and less. However, our break even price is all the way around $54.38. Now, if it were to keep going down lower than that, then that's when the contracts will become worth less and less and less. However, we don't care about that because we were 100% fine with owning the shares at the strike price that we selected. Because not only did we get paid to sell the puts, but now that we're being forced to buy the shares, we're also going to collect that monthly dividend. So that is the put side. However, things get even more intriguing once we enter into the call side. All right, so here we are back at the options chain, and let's assume that we were assigned the shares at $55. Now we can go ahead and sell covered calls anywhere up to our cost basis. So we could turn around and sell covered calls at $55 if we wanted to. Because remember, when we're selling covered calls, we're just agreeing to sell our shares. And typically I go again within 45 days when selling the covered call. However, with this strategy specifically, with the dividend wheel, because I'm going to get paid monthly regardless, I am fine with going out to a further expiration date. So for this example, let's go ahead and go out to the next expiration date, which is July 18th, which is 51 days out from now. So we'll select that. And here I would likely select the strike that is closest to my cost basis, which in this case would be $55. And we can see that we will receive anywhere between $180 to $195 per contract. So if we were doing that on 5 contracts, then that would be almost $1,000 received for agreeing to sell your shares at $55. However, if you want a few dollars of capital appreciation, then you could come to the next strike and do the $57.50 strike, and you'll still receive anywhere between $65 and $75 for doing so. But that is Realty income, ticker symbol O. But what if you prefer an ETF because you don't want any single stock risk? Well, that's where we can do one of the other 2 options that we looked at. So let's take a look at QQQI. Now looking here at QQQI, we can see that over the last 6 months, it's traded anywhere from a high of $54 all the way down to a low of $41. So that is still a pretty tight range. And it only got down to $41 during the tariff crash, but we can see most of the time it's been trading between a range of about $48 and $54. So being that the stock is currently $50, it's right at about the middle of its range. And we can see that with the Bollinger Band, it is currently right here in the middle. And the Bollinger Band says it shouldn't go much lower than about $48.80. But let's go ahead and head right back on over to Thinkorswim. So now we have the options chain pulled up and we'll follow the exact same process. So let's go ahead and open up the same expiration date that was 23 days out from now. And we could sell either this $50 or $49 put. However, again, since I am 100% fine with being assigned the shares and collecting that 13% dividend yield, then I'll go ahead and select this $50 strike, which is closer to the money. And we can see we'll receive anywhere between $45 to $70 per contract. So if we go ahead and hit the bid price, and we'll do the exact same thing, we'll do 5 contracts. And at the mid price, we'll receive about $57 for selling these puts. Well, now let's take a look at the P&L chart, and we can see that $285 is the maximum that we'll receive for placing this trade. And that's if the stock price stays the same, if the stock price goes up, or if the stock price goes down. However, if it goes down below our $50 mark, then we'll start to make less money on the options contracts. And then our break even point is right around $49.40. And then if the stock price goes down from there, then the options contracts become worth less and less. However, again, we were fine with purchasing the shares at $50. And actually, we really want the shares because we actually make more money once we actually collect the shares. So that's great. Let's assume that the stock price did drop down below $50. So let's go ahead and take a look at the cover calls. All right, so now we're back at the options chain again. So let's select the expiration dates that we want to use for the cover calls. Now this time, let's assume that you want to make sure that you keep the shares for at least a few months in order to guarantee that you collect the dividend payments every month in the meantime. Well, now let's go a little further out. Let's go to this expiration that is 79 days out. And from here, again, we can select any strike that is at or above our cost basis. So we could do the $50 strike or we could do the $51 strike. But let's look at the $51 strike. We would immediately collect anywhere between $65 to $110 per contract for selling these covered calls. So let's go ahead and do that. Let's select on the bid price. And we had 5 contracts. So we'll go ahead and load that ticket up. And at the mid price, we'll receive about 87 cents per share, which is $87 per contract. And let's take a look at the profit and loss chart. And we can see that we'll receive $435 for placing this trade. Now, as long as it stays right around the price it is now, we just keep the $435 and we go about our day. If the stock price does go down, then we keep that $435 we were paid and we go about our day while still being able to own the shares of the company. And if the stock price goes up all the way up to our strike price of $51, then we just keep that money we were paid and we go about our day. However, when the stock price goes beyond $51, you'll just be forced to sell the shares that you already have at that $51 strike. And that is my strategy that I've nicknamed the dividend wheel. But if you'd like to learn more from me, feel free to come join the Trade Freedom community. We would absolutely love to have you and help you generate more income off the cash that you already have. The link is in the description below. But other than that, make sure you like the video, subscribe to the channel, and I will see you guys on the next one. Peace!